Hello, I'm Rebecca McLean and I co-manage the Dunedin Income Growth Investment Trust. I'll start with an introduction to the trust. So what we're looking for is to deliver resilient income and long-term capital growth. And we do this by selecting high-quality companies in the UK and in Europe, which are chosen because of their ability to deliver income and capital returns. The trust also has a sustainable investing approach, which allows us to reduce exposure to the parts of the market with the highest environmental, social and governance risks, and also seeks out opportunities. So there are 4 points of differentiation for the trust. The first is that it's active. The trust has got 36 holdings and it has a high active share. The second is that we're looking for resilient income. So these are companies which are able to deliver income through different economic cycles. Often these are supported by long-term structural growth trends or strong market share opportunities. The third point of differentiation is this focus on total return. So we're not just selecting companies which have got a high yield. We want companies that are going to give you that dependable income generation, but also the ability to grow their capital through the cycle. And the fourth point of differentiation is our sustainable investing approach. Here we're looking to select sustainable leaders and improvers from the UK and European market. And we also engage with the companies in the portfolio in order to understand these issues and support companies through their journey. So that's the objective and the process. In terms of what the portfolio looks like, as I say, it's mostly UK companies. The trust has the ability to invest 25% of assets overseas. Currently, the trust is shaped with 50% of the assets in the FTSE 100, which are the largest UK companies. We have 30% of the trust in UK mid-caps and small caps, and we've got about 20% of the assets in selective European companies. So now I'll move on to performance. It's certainly a challenging market with a number of factors impacting companies and economies. We've got risks around persistent inflation, the impact of rapid tightening, we've got geopolitical risks, and these are really creating a challenging environment for companies to operate in. In this context, though, it is reassuring to see the performance of the trust, which has performed well relative to the benchmark of the FTSE All-Share over the last year and also over the long term, over the last 5 years. In terms of what's driven the outperformance versus the FTSE All-Share, I'll name a couple of positive contributors. So the first is RELX. This is a very strong company. It's servicing a range of clients and providing data and analytic tools to those customers. What this has meant is that the companies continue to deliver resilient earnings growth. And indeed, the level of growth that the company is delivering currently is ahead of history. So it's really seeing that demand pull from customers for their data analytics services coming through. And this is translating into strong earnings growth and also dividend growth. The second top contributor to the trust performance over the last year is Novo Nordisk. This company has a novel anti-obesity drug, which, whilst the drug is facing a nascent market, this does provide a very large addressable market. And recent trial data has showed that the drug not only addresses obesity, but it also has positive implications for the cardiovascular outcomes for patients. So this is clearly a huge unmet need which the company is addressing, which supports the future growth outlook for the business. The third company I'd highlight is not holding British American Tobacco. So the company has underperformed this year, and so by not owning it in the trust, this has been a positive contributor to performance. And I think it's worthwhile talking about some of the reasons why we don't own British American Tobacco in the trust. So firstly, it doesn't meet our sustainability criteria, which does include an exclusion for a number of business practices which we identify as being unsustainable, and tobacco is one of these sectors. But the company really is facing a challenge in terms of its volume declines are accelerating, and the mechanism that it's used historically in order to offset volume declines by strong pricing is weakening. And so this really does create uncertainty for the outlook for the business, and it's a challenge for the markets to value the long-term future cash flows of a business facing these headwinds. So it doesn't meet our sustainability criteria, but the company also it does not meet our quality criteria given the declines from a volume perspective and also the leverage within the business. And then on the other side, I'd highlight two names which have been negative detractors to the trust. The first is not owning Shell, which is the integrated oil and gas company. It has enjoyed a strong delivery of earnings and free cash flow this year, supported by underlying commodity prices. And this isn't held in the trust. The second company is the construction materials business, Marshalls, which we own. So this is a UK mid-cap company providing paving stones and solutions in different end markets, but they're mostly around construction and house building. And the house building sector in the UK really is continuing to face a challenging outlook, with volumes down 20-30% from last year on the back of rising mortgage rates and also volatility within those mortgage rates impacting customers' willingness to buy new homes. So we've seen this translate, unfortunately, into the company's earnings, and we have seen the company's profit expectations for the year come down. That said, we've maintained our holding because the valuation has also come back. So when we are thinking about the future outlook for the business, we think there's a positive opportunity for not only recovery in the underlying earnings when the volumes come back, but also for the valuation of the business to reflect that. So not only an earnings story, but also there's a potential re-rating opportunity within the trust. So that's the main drivers of the NAV performance. And as I say, it's been a good year over the last year and also over the longer term, the last 5 years. But I think it's also worth highlighting that the share price has lagged the benchmark of the FTSE All-Share this year. The discount has widened from typically trading in line with NAV to being at a wider discount than history. The trust is currently trading at about a 5% dividend yield, and this is at a premium to the FTSE All-Share. This year marks the 150th anniversary of Dunedin Income Growth Investment Trust. Founded in 1873, the then named Scottish American Investment Trust invested in the then emerging markets of the United States. So the trust has come a long way in 150 years, and the name has changed, and so has the assets that we invest in. But the underlying objective remains the same. That is to develop a diversified portfolio of companies which provide resilient income delivery and capital growth through different economic cycles. We currently have a concentrated portfolio of 36 UK and European companies selected for their ability to deliver income, but also attractive capital returns. And whilst there are a number of headwinds facing markets currently, we are positive about the prospects of the companies in the portfolio. We think that this approach to quality and also sustainability puts the trust in a good position when facing an uncertain economic outlook. In terms of what we've been doing more recently in the trust, we have been adding to names which we feel have been underappreciated by the market and have lagged from a share price perspective. So I'd highlight Oxford Instruments, which provides scientific tools to academic and commercial customers. The company has a very strong IP set of products, and this creates competitive strength for the business. But there are a number of cyclical end markets that the company is exposed to, for example, semiconductors, and also sells into the Chinese market. And there has been concern from the market about the ability of the company to deliver with these challenges facing it. But we continue to like the story and have been adding capital to the name because we feel that the long-term growth prospects of the business are not reflected in the valuation. And indeed, more recent results from the business and our more recent company meeting indicated that the company is doing a very good job of navigating these uncertain times. This quarter, we also introduced a new holding in National Grid. The company plans to invest 40 billion in UK and US electricity networks over the medium term, 29 billion of which will go towards decarbonising the network. There is a huge amount of investment required to upgrade the electricity networks in the UK and in the US, and National Grid is really at the heart of that transition. This investment means that the company is expecting its assets to grow, and in turn this will support earnings and also dividend generation in the business. And this is really allowing the company to grow after a period historically where there's been little growth. So it's helpful from a growth perspective, but also the company does have an attractive dividend yield which supports the income requirements of the trust. From an ESG perspective, we see it as a solutions provider because the company is enabling the decarbonisation of the grid, but it's also providing energy security in the UK and in the US. But there are some challenges which face the business. We will continue to engage with the company on how they're managing their community impacts, particularly when there are areas of the UK which require construction in order to build out the required network. So in order to fund these purchases, we have reduced some holdings and we've looked to exit Coca-Cola Hellenic. The company has seen its share price recover strongly following the Russian invasion, given its exposure to the region. And the company's continued to deliver good results. But we think that the valuation now reflects that outlook, and so we see less opportunity for a re-rating from here. So maybe now turning to the outlook. As mentioned, there are a number of challenges facing global markets, and this does create uncertainty. Indeed, in the most recent earnings season, we've seen a number of companies reduce their profit expectations for the year, and a number really do point to low visibility going into next year. So whilst the markets and economic environment has remained more positive than people had expected going into the year, recession risk is still present. So given that outlook, we are looking for companies which have got strong industrial exposures, business models and competitive moats, which will allow them to navigate these periods of uncertainty and come out stronger through the cycle. So given that, we do feel positive about the prospects of the companies in the portfolio. Indeed, the valuation of the UK market is really at very attractive levels versus history and versus other markets. So we do see a number of attractive opportunities to invest in resilient and innovative quality companies at attractive valuations currently. We will continue to look to protect capital and deliver the resilient income for the trust as it has delivered historically. If you'd like more information on the trust, please click on the link below.